Lemon Tree Hotels is the stock that we are putting the spotlight on after a good performance in a seasonally strong quarter. The company also reported its highest ever revenue, EBITDA and profit during the quarter as well. To discuss this and more, we are being joined by Mr. Patanjali Keswani, who is the Chairman and Managing Director at Lemon Tree. Mr. Keswani, good afternoon. Thank you for joining in. Let's start off with some multiple short questions actually. What has been the occupancy rate this quarter? 1. What do you see that going into this fourth quarter? 2. And how has Aurika picked up during the quarter, because your occupancy in the end of the quarter was at 71%. Do you see that going further higher?
Good afternoon. Well, we closed this quarter at 74%, which is about over 8% over the previous year same quarter, which was 66%. Aurika had just been launched in the previous year same quarter, and it had done about a little under 40%, and this year it did 72%. So overall, it was obviously, it deflated our occupancy. We would have, without Aurika, we were a little higher than 74.5%. But how going forward, I see Aurika just going from strength to strength. So this quarter, certainly it will do much better than Q3. And as a company overall, we will also do much better than Q3. And in fact, I don't like to give guidance, but this Q4 will be the best ever quarter in the history of this company.
Mr. Keswani, you're saying that Q4 will be much better than Q3. Q4 will be the best quarter. Earlier, you had given an FY25 revenue guidance of 1,250 crore at over 50% margins. In fact, the 9-month margins at 47%. Will you be revising that guidance upwards, and can you give a fresh guidance as far as FY26 is concerned?
No, I don't want to give well, I think Q4 will be such that we will be, what I had said is we will be around 50%, and I think I stick to that. We will be around 50%. And as far as revenue goes, well, for the full year, I have some numbers here. Let me have a look.
Sure, sir.
For the full year, yes, I think we will be there, if not slightly better.
Maybe there, if not slightly better, Mr. Keswani. Interesting. Well, how would you split your growth for the future in between your ARRs and occupancies? Your ARRs were up 7% during the quarter, and you had also mentioned that both ARR and occupancies will increase drastically in the second half. What are you penciling in for FY26?
Well, that's guidance. I don't want to give it, but I can tell you FY25 Q4 will be outstanding, and I'm pretty sanguine that this performance will continue into Q5. The advantage into the next financial year. The advantage of, what will happen is two things. Aurika will get fully stable next year, as it's showing signs already in Q4. And the Keys portfolio will start giving significantly higher returns. So these two added with the normal growth of the remaining portfolio, which is normally over 75% anyway, should lead to a significant improvement in FY26 over FY25.
Understood that, Keswani. So you're expecting occupancy rates to improve. Give us an expectation in terms of capacity addition. What is it further that is expected, especially when you're talking about Aurika as well as the Keys Hotel? Occupancy, could you give us a trend? What is it that you're anticipating? Also, as far as your entire portfolio is concerned, what are the number of rooms that have been refurbished, and how are the economics of the renovated rooms playing out?
So we have, as I had said, I think earlier, that we want to refurbish all the hotel rooms we would have normally done during COVID. So those 2 years, and then continuing into 1 year after COVID, where our balance sheet was obviously in a repair format, we were not able to renovate anything. Now, typically in those 3 years, we would have renovated 50% of the portfolio, of our own portfolio, which is 3,000 rooms. So including catch-up, because every year we renovate 1/6. We are planning starting from last year, this year, and the following year to renovate about 4,000 rooms. Okay. And that costs typically 7.5 lakhs a key. So basically 300 crores in renovation. And I think when that gets over, then we'll go back to our normal renovation, which is about 1.5–2% of revenue. and therefore our EBITDA margins will then, on a very sustained basis, cross 50%. And actually, well, if things continue as they are, then it will be north of 52, 53%.
One final quick question, Mr. Keswani. You're expecting fourth quarter to be a historic one. So what does that do to your debt? You had around 18 to 1900 crores at the end of the first half. Where does it stand now? And do you tend to bring it down over the future?
No, what I had said is we'll be debt-free in 3 to 4 years, which I'm sticking to. Of course, if we list Fleur, which is our joint venture, where we own a majority, if we list it in the next year or two, then we will go debt-free instantly. Our total debt by the end of this year will be about 1600 crores, and next year will be 1200, maybe 1200, because we are spending a fair amount in capex, as I said. So our target is very simple. I think the ideal debt to EBITDA should be less than 2. So we will be well less than that.
Okay, Mr. Keswani, thank you so much for joining us. You're facing a paucity of time, else would have loved to ask you many more questions, but we'll get you soon on the channel to get further insights into the business.